We have some new GDP numbers out in the U.S., a bounce back for the American economy from April to June. Let's go to Phil Blancato, who's Chief Market Strategist at Osaic, for more on this. Thanks for joining us today.
Hi, thank you for having me.
So a negative start to the year for the U.S., a more robust starting April. What's your read on that?
Well, you know, there's a number of different aspects of what's happening in the marketplace right now. You think about the earnings cycle so far this year has been quite strong, regardless of some of the headlines that have taken place, whether it's noise around the Fed or the potential of slightly higher inflation. The current equity market, while not cheap in the United States, certainly not cheap from a valuation standpoint, is really putting up impressive earnings estimates. And for that reason, the market's reflecting much stronger breadth recently. And even with the Mag 7 leading the way, there are other opportunities in the marketplace.
Okay, so let's talk about tariffs for a moment and whether you saw tariffs work through. Are they still working through? Is that why you're seeing perhaps better results for the second quarter, people sort of front loading and then not having to deal with the tariffs in the second part of the quarter?
Yeah, exactly. So what you're seeing is this. Leaving GDP aside for a second, we know the first and second quarter were very unusual. Third quarter will be much more realistic. So far, the tariff component in our analysis is broken down in three parts. 1/3 by the manufacturer, 1/3 by the distributor, and 1/3 by the consumer. So with much of the tariff noise at least mostly out there, we know that these things could change. By example, India, and certainly with not the full conclusion with China. For the most part, we think Mexico and Canada are moving along relatively well, and so Europe mostly figured out. Again, mostly. We're able to have a scenario right now where we believe the tariff noise is going to cost the average U.S. consumer around $700 a year. Subtract out about $200 a year for lower gasoline prices. The consumer is going to survive this, and you're seeing that somewhat reflected in corporate earnings with less of a tariff bite and still a very strong U.S. consumer.
You mentioned the tariffs right now are being divided three ways, and we've heard some of the retailers say, yes, we've been absorbing the tariffs either through suppliers or through our own system. But some are saying we're going to have to pass it through for the second half of the year. So do you expect more of a price increase in the second half of the year?
I think we've seen quite a bit of it already. This modest turnaround you've seen in prices, whether we look at PPI, CPI price components, ISM services specifically. It seems like there's much more price increase in services than actual physical goods. So I know we do not think there's a significant price bump to come here. We think there's enough margin in the middle here that the consumer will absorb some of it, but no more than maybe at most 40% of it. So what you're seeing right now is this modest tick up. Recently, you saw it in headline CPI and headline core CPI. We'll find out tomorrow with PCE what it shows us, but we're not expecting a significant enough bump in inflation to really concern the Fed.
Okay, let's talk about AI investment. NVIDIA reported a 56% revenue increase for that company, but the stock has been falling. Do you think investors have been expecting too much from the tech giant?
I think so. When a company's priced to perfection and you're expecting it to hit on all cylinders, and I would argue it did. I mean, you look at its revenue beat, you look at its sales expectations, you look at certainly the margins, which are quite incredible. Now, don't get me wrong. I see the company trading at a 60 multiple. Certainly, that leaves you reasons for pause. But I think when you look at the whisper number and you ask yourself, what wasn't included was certainly China and the opportunity that China may or may not represent. Again, tariffs and the current administration. But seeing, even without that as part of the narrative, I think the number was good enough to warrant the stock holding on here, except the reality is right now the company is not inexpensive with the run that it's had this year. I think the AI boom is just getting started. I think there's so much more runway here. We expect 1/3 of all corporate revenue from a CapEx standpoint to be AI spending over the next 5 years. So maybe this number didn't overly impress, and maybe the company's priced to perfection, but the AI space in general is still wrought with opportunity.
Okay, so let's talk about some of your stock picks. First up is Citibank. What do you like about Citibank?
It's cheap. And, you know, when's the last time you go buy a big bank with the yield curve staying relatively high on the long end of the curve? The short end, in theory, might come down, but their interest rate opportunity, the amount of money they make on cash, should stay strong for quite a long time. Stop trading at a 10 PE, below its peer group, below its historical averages. It's a turnaround story. You're looking at their debt to equity ratio. You look at their growth story. Over 200 million customers globally. I just think it's a very safe play in a company that could really reward you you over the next 5 to 10 years.
Okay, your next pick is Uber. Uber, where are you looking at growth? Is this sort of driverless cars, or is it more markets you expect Uber to expand to?
I think there's 4 things you got to think about with Uber. That as a public, Uber's become synonymous the same way Coca-Cola is. You think about buying a soda, you say Coke. You think about going in a driverless car or a ride app car, it's Uber. And you see their separation from the rest of the herd. So part 1 is because I think not only is it a U.S. story, but now it's a global expansion. As they expand into Asian markets and South America, that's a real revenue boost for them. Their sales over the last 3 years have increased every single year. That's the second piece. So not only global expansion, but now you're seeing sales growth. And then just today, they announced this partnership with Dollar Tree. And that Dollar Tree will be able to give them product that they'll be able to bring home. The ability to expand their fleet, which they're looking at trains, freight, airlines, they're expanding in a variety of different places, I think adds to additional revenue. And then you hit on it. The fact that driverless cars are going to cost less than driver cars is a further revenue boost, and that's right around the corner. So I think the company has a real upside here because it's becoming a global name and a global franchise. And the one thing they need to do was diversify their revenue line, and that's happening as we speak.
Okay, I do want to get your last pick, Ralph Lauren, and I'm wondering why you are choosing this designer brand, especially considering right now some of those spaces that aren't high-end luxury are getting softer.
I think it's a great question. The reason why I chose it, you look at the return on equity on this company, and it's far cheaper than it's been any time in the last 5 years. Now, their PE ratio is a bit expensive, but you're expecting earnings growth of upwards of 10% next year, and you might get as much as 30% for the remainder of this year. The name has a turnaround story to it as well. You're seeing a rebrand to the younger generation, and while I don't disagree that the tariffs could play into this a bit, I think it's a name that's able to supersede that. And you see it purely in their earnings forecast. You see it in their overall revenue growth, and when return on equity is lower than it's been, and you've got this opportunity to really buy a stock that I think has exponential room for growth. Think about which of the winners and losers in the apparel space. I think they're one of the winners. I think you're getting it relatively cheap.
Phil Blancato, good for you to join us, sir. Thank you very much for your time.
Thank you.